Good morning, good afternoon, good evening, wherever you are listening to me. Welcome to another episode of Wealth Building Conference. My name is Oludare Fasola. Tonight, we're going to learn and dive into another topic for medical professionals. But before we go into that, I would just like to thank everyone that have been joining us. Wherever you are joining us in any part of the world, please, I want you to please put it in the comment section, your name and where you're joining from. The reason is just because we just want to meet you, want to connect with you. And this webinar is going to be an interactive session. So if you have any question, please drop it in the comment section. I'm going to quickly attend to that immediately or, during the webinar. Again, if you have anybody who is a medical professionals or business owners, please send this link to them and let them join us. We just want to show them how they can build wealth in such a way that they can also pass it on to their loved one. I've seen many businesses, the moment the owner died, that marked the end of that business. So how can we do it in such a way that whatever we build while we are alive, we can pass it on? And of course, how can we actually sit down and reset our financial structure? So tonight we're going to be talking about financial reset for medical professionals, how you can actually look into your structures, even if you don't have the foundation, if you don't put it right, how can you sit down and reset? So that is why we're going to dive in tonight. So I'm just quickly going to pull up my slide. Tonight, we're going to be talking about financial reset for medical professionals and business owners, how you can rebuild, reduce taxes, and create long-term wealth, right? So now, let's quickly look at the objective of this presentation. Number one, so we're going to look at where money is escaping in your structure. Like, are you making money and you keep asking yourself, where is this money? So we're going to look at the spots, the leaks. So two, we're going to look at how you can reduce taxes legally and efficiently. Three, we're also going to look at how you can protect your income and secure your lifestyles, and put into clear action plan a financial reset you can execute. Let's quickly look at the reality. I've been saying it over and over in every of my webinar that it is not how much you make, but how much you can save from taxes. So, the reality of today is that many medical professionals and business owners are overtaxed. They're paying more taxes than necessary. I'm talking about if you pay yourself salary, or you pull out dividend from your corporation, you pay taxes depending on your profits, depending on your income. You could pay up to like 40%, 36 to 40% in personal taxes. Again, in your corporation as well, after claiming all the expenses, in Ontario here, your first $500,000 is taxed at probably about 12.5%. Now, your passive income again is also taxed about 50% taxes. So you can see if your income is not structured properly, you could lose up to 50% of that money to taxes. Two, poorly structured, no clear financial architecture. It's not just about incorporation. A lot of medical professionals I know, what they know is that once I incorporate my business, I will save money from taxes. Incorporation is just little out of what you can do to save on taxes. What about the structure? How do you take money from your corporation? Do you take salary? Do you take dividend? What are the advantages and disadvantages of this? And how can you really make sure that you structure your corporation in such a way that you know how much you can take as salary and how much you can also take as dividend? Three, so do you know that you're equal to your income? Do you know that one illness can actually cause a financial disruptions in your corporation? Many medical professionals, many medical business owners doesn't know this, and no long-term plan. Income is high, but efficiency is low. So I've seen many business owners. They earn so much, but they have nothing to show for it. So that's what we're going to be looking at tonight. Let's look at where money is lost. Number one, overpaying taxes. And like I mentioned in the first slide, right, you could lose up to 40% of your income to taxes if you don't structure your income properly. tax is number one biggest destroyers of wealth. If you don't know how to properly structure your income, it's very difficult for you to build wealth. No wealth strategies. Like, it is not about making money, but you have a strategies in place in such a way that you keep more of what you earn and you also pass it on to your next generation. Again, critical illness and disability gap. You know, it's not about just having life insurance and critical illness. But what about disability income? Like, if you disable, how do you make sure that that will not affect your practice? So you have to make sure that you protect yourself from critical illness and you also have enough disability insurance in place to ensure that if anything happened to you, your corporation will still continue to run. Idle corporate cash. How do you manage your retained earnings? If you claim all the expenses from your corporation, you apply your 12%, how do you manage the remaining profit? How do you invest that in such a way that it's not going to subject to another passive income taxes? So biggest mistake is that making money without a plan to keep it. That is the biggest mistake you can ever make in your corporation. So let's look at the financial reset framework. Number one, structure. You need to have a tax efficient VAP corporations and planning. Now, so when you have a corporation, you must have structure of how you want to minimize and mitigate taxes. I don't have any problem in paying taxes, but if there is a legal way to save what you earn from taxes, is very, very powerful. Now, what I'm saying about tax efficiencies is this. Now, what is the structure? How do you really pull money out of your corporation? Do you take salary? Do you take dividend? Now, when do you need to take salary? And each of these have advantages, right? I'm not a tax expert, but what I know, right, before you implement any of these strategies, please consult your accountant or tax planner, right? This is not a tax advice or a legal advice. Please take note of that. But what I'm trying to say is that, for example, if you are taking salary from your corporation, it will give you an opportunity to save some money in like CPP, and and you also have opportunity of qualifying for some of credit, because when bank want to evaluate you, they evaluate you based on your income, especially your personal income. I'm not talking about the corporate income right now. So those are the advantages of taking salary. But it's also important that you also look at dividend. When you need to take dividend, maybe at the end of the year, you look at what you can actually take out as dividend to actually save you from taxes. You need to discuss this with your accountant. And you need to understand that these two strategies are very powerful in to structure your practice. Now, two, life insurance, critical illness, and disability coverage. Before you invest, before you start building, the first thing is to protect yourself from death, from sudden death, from critical illness, from disability. Now, I've seen many business owners, because of one single critical illness, it wipe out their savings and they are unable to practice again. But with critical illness in place, with life insurance in place, with disability insurance in place, do you know that you can save all of this as well? And this is the reality. One in out of Canadians who have disability that will last more than 90 days. So if you are starting with 3 people, it means that 1 out of 3 people will have disability that will last more than 90 days. But who is that person? You don't know. So what do you need to do? Protect yourself from disability, from critical illness, and of course, if there is sudden death. Growth, long-term wealth strategy. So in Canada here, there's what we call deemed disposition. Deemed disposition means that if you pass suddenly and you don't have plan in place, your asset is deemed to be disposed, right? And when it is disposed, CRA will take their call, and you can lose up to 40-50% of that, right? Now, how do you do that? You make sure you consult, you have powerful strategic estate plan in place in such a way that if anything happens, you keep and you save your asset from deemed disposition, liquid when needed. Now, some people, they are asset rich but cash poor. I will repeat that. I've seen so many medical professionals and business, they are asset rich but cash poor, meaning that, let's say, for example, they have a lot of real estate, for example, but they cannot access the cash. So it is not about building wealth, right? If you are acquiring asset, how easily you can convert or turn this asset into cash. No, if you have so many assets and you are cash poor, then there is a problem, right? So you need to understand that there's difference between being assets, have enough asset, and have liquidity. As I said, some people are asset rich but cash poor. So you need to balance the two. Wealth is not just built, it must be designed. Now, let's now fix the structure. Let's now look at, this is how you can fix number one. So you need to look at salary via dividend strategy. So, like I said, I am not a tax expert. Please consult your accountant and your tax planner to, explain all of this for you, when it is important, when it is necessary for you to take salary versus dividend. What are the advantages of the two? Each of them have this different advantage. So you need to understand when and how you need to implement this structure. Number two, reduce unnecessary tax exposure. I was speaking to one of medical professionals 2 days ago, and the CPA was advising him, say, look, we're going to put a structure in place in such a way that every month we set some money aside to pay, down your taxes. You don't need to wait till the end of the year, right? Now, why many people struggle is that they leave everything until the end of the year when they file their tax and they realize that they have a lot of tax exposure they cannot, pay, right? And once you don't pay, GCRA give you maybe some days after that, they start up, they start putting add interest, and that becomes a problem for you. So you don't need to expose yourself to unnecessary taxes. Optimize corporate earnings. So now, how do you treat your retained earnings, right? Now, when you make money from your corporation, how do you now manage the profit of the corporation? So you need to have strategies in place. Most medical professionals focus on income, the wealthy focus on structure. Structure is very, very important. Now, take action on structure. What you need to do is review your tax strategies, audit your current approach for inefficiency. As I said, please consult your accountant, consult your tax planner to align your structure with you, to align your structure. Number two, you need to speak with advisor and accountant that are working together. So now I just want to encourage you, right? When you have an advisor, please make sure that they have, this collaboration with your accountant. It will help you a lot to save a lot of your money from taxes, because the work of accountant is just to prepare your books, file your taxes. If there's any audit, advisor will help you to structure your wealth, like your money, how you can build wealth, how you can protect the income, how you can also, invest your retained earning, how you can be asset rich and cash rich, because it's not about having asset, but you also make sure that you have enough liquidity. All right. So it is important, you need to do that. You are your greatest asset. This is number two. Now, you are equal to your income, right? One illness, one sickness can consume your practice. What if you get sick? What if you go to that clinic and you're unable to come back? Right? What if disability happens? What about critical illness, stroke, cancer, heart attack? All this is very, very important. You need to have the structures in place to protect that. What if you can't work again? What if there's any disability and it leads to, complete disability, you cannot work? How do you manage yourself? How do you pay your mortgage? How do you pay your rent? How do you pay your daily expenses? How do you pay your insurance? It is very important, right? What if income stops? What if you cannot come back to that house tomorrow? What if accident happen and it just consumes your life? It's a hard conversation, but we just need to let you know that it can happen to anybody, right? Step two, protect your income, right? You need to protect your income. So this is how to do that. You need to have disability insurance in place. That will help you to replace your income if you can't work. Critical illness will actually give you a lump sum for serious diagnosis of any of the condition, either stroke, either heart attack, either uh, um, either cancer. It could be anything, but once you have a criticalness in place, this will pay you a tax-free lump sum to take care of yourself while you are recovering from it. And life insurance, you need to protect yourself. You also need to look at how can I transfer this, right? So we're going to work with you, with your accountant, put all these structures in place to make sure that you don't fall into financial vulnerability, right? If there's no protection, there's going to be financial vulnerability. Three, build tax efficient wealth. Tax advantage growth strategies that shelter your gains. So now there are various ways in which you can actually do this, right? So we have, is either you structure it within your corporation or outside your corporation. But there are other strategies as well that we can put in place to ensure that you have enough wealth when when you need it. Now, when you are building wealth, when you are building or you are having, you are buying real estate, you are buying that, you are buying this, you also need to understand that all those things may trigger tax gains at the end of the day. So put a strategies in place. We're going to put a strategies in place to make sure that you have access in a tax-free environment. Again, you need to also create reliable long-term cash flow. Right now, I'm talking about in a tax efficient way, right? And we're not going to leverage on this alone. There are other strategies that we're going to implement. We are looking at a tax efficient way that you can put something in place that when you need it, you can access the tax rate. And again, you need to protect your capital, protect what you build. Now, wealth is in sequence, right? You protect first before you build. But I've seen a lot of medical professions and businesses now. What they do is they start investing, they start building without protecting. Because why? The reason why you are building, the reason why you are investing is because you are making money. So it's not important for you to protect first before you start investing. So it's not how much you make, it's how much you keep and grow. Number four, create access and flexibility. Build liquidity into every layers of your strategy. So as you are planning, as you are progressing in your practice, every of your layers at every time, every stage, you must make sure that you build liquidity. As I said, it's not about acquiring asset. You also need to be cash rich. So if you need money, a lot of people put money in real estate. In the last couple of years, people have experienced so much, loss in real estate. So this is what I'm trying to say here. Like, it's not about building, asset. You also need to be liquid. If I need money, if I want to expand my clinic, I must have enough cash for me to do that, right? Again, you must avoid lock-in traps. Money you can't reach is not working for you. If you have asset, if you have money and you cannot reach it, you cannot access the money. It's as if you are putting your money in it. You are trapping yourself. So don't do that to yourself. Seize opportunity, access capital when it matters most. Like you want to expand your clinic and you are struggling. It's not supposed to be so. When you have your return and you put it in a way where if there is need for you to expand, you don't need to go to the bank. You can quickly go into your family bank and access money, and this can be built outside your corporation, and this will provide a long-term work strategies for you to expand and to also pass it to your generations. With wealth without access is frustration. This is the summary and the takeaway. Number one, high income plus no structure is high risk. And you should understand that. If you are making so much money and you don't have a structure in place, you are risking everybody. A lot of people they are just accumulating return earnings in their, one of the important advantage of incorporating is tax deferral. But when you are deferring taxes, do you have strategies in place that will help you to put this money in a tax efficient way? You need to understand all of that. So don't do that to yourself. Talk to your accountant, talk to your advisors. Let's put the strategies in place to ensure that you don't just defer taxes, but you build strategies in such a way that when you want to take out your money, you don't create, it doesn't lead to tax exposure. Tax are your biggest expenses. You need to control it. If you don't control them, it's going to be eating so much of your earning. Protection, secure your lifestyle. Don't leave it to chance. Cover yourself with life insurance, critical illness, and disability insurance. It's non-negotiable. Before you start investing, before you start building anything, protect first. I said wealth is built in layers. Protect first before you invest. Don't go and invest before you start protecting. After all, Why you are investing is because you are making money. If you cannot make money, if you cannot work, how do you get money to invest? So protect yourself first before you start investing. Wealth must be intentional. It must be strategic by design. Work with experienced professionals to structure something in place for you. You don't need to earn more. You need a better system for what you already earn. Some of you think that, oh, I need to make more money. You don't need to make more money, right? The one you are making, do you have a structure in place to make sure that it continues to grow for you? So take action today. Number one, review your structures, assess, account, and plan. So you have to review your structure, right? And you look at different accounts you have. If there is need for you to restructure, if there is need for you to diversify, please try to do that before it's too late. Two, identify gaps. Find what key financial shortfalls. So if there are shortfalls in your plan, please look into that before you start building on something that is not going to last. Three, book a strategy call with your advisor, with your accountant to make sure that you are in the right path. Your financial research starts with a step. Okay, don't wait. Your future self will thank you. So thank you so much today for joining my session. It's been an amazing session tonight. Very short, direct to the point. If you have any question, right, please, if you have any question, you can drop it in the comment section so that we can quickly look into that. If you have any question, all right. I don't think there's any question. For those of you that have joined today, I really want to thank you so much for joining. Next week is going to be another session for Wealth Building Conference. On behalf of Wealth Building Conference team, I say thank you so much. Happy Easters, and do have a nice weekend. Bye for now.